One of the largest banks in the United States, Silicon Valley Bank, collapsed completely within 48 hours. How then did the 16th largest U.S. bank go bankrupt so rapidly? Well, SVB Bank is the indicator that we're already in a recession. Like the fall of Lehman Brothers, SVB will cause a worldwide recession. What then caused the largest bank in the United States to fail so spectacularly and so quickly? SVB saw an impressive growth in the early stages of the pandemic. SVB dropped rapidly in early 2022 and reached zero the year following. It's one thing to hear predictions of a financial meltdown, but uncommon to watch a major investment bank go under debt trap. And now it's clear that clients have observed the bank's collapse. Since the failure of SVB might have a major impact on the finances of over 1,500 technology firms. In addition, a continent-wide sell-off of SVB's equities has completely wiped out about 20 billion Canadian dollars from banks across the country. The true mystery here is what caused such a steep drop in SVB's share price. In their nearly 4 decades of operation, SVB had worked on their expertise as an intermediary between VC firms and the entrepreneurs they funded. In 2020 and 2021, the marketplaces for tech businesses and startups were thriving, attracting enormous investments in new companies and projects. And whenever a startup found itself with millions or billions in capital, they always put it into Silicon Valley Bank. The assets of Silicon Valley Bank jumped from just under $70 billion to approximately $210 billion within a short period of time. They were 3 times as wealthy in just 2 years, but the influx of fresh deposits presented a new challenge for the bank. Loans had been a major source of revenue in the past, but they were swiftly depleting their reserves. Without access to additional credit, the company was forced to find alternative uses for its newly acquired billions of dollars. As a result, they ramped up their efforts to invest in the stock market. Long-term financial investments intended for sale at a later date, maybe many years down the road. And during that time, with net SVB, they were sure to make money so long as they didn't dump their shares too soon. Even if they did, they'd have to unload them at retail. The SVB executive team reportedly invested $70 billion on these securities. But at the time, nobody cared, and things appeared to be going smoothly. The bank had more money than ever heading into 2022. Then again, what could go wrong? As it turned out, SVB and its management were right there in the heart of a gigantic bubble. After leaving them at essentially zero throughout 2021, the Federal Reserve decided to start hiking them as the economy began to deteriorate following the post-pandemic rebound and inflation became a concern. And it produced 2 significant outcomes for SVB. For starters, it instantly reduced the value of their $70 billion in investments. SVB became extremely overexposed as their value dropped. Only $15 billion were assigned to 1/3 of their assets. Therefore, selling them would be a catastrophic mistake. And given that tech companies were SVB's primary clientele and the source of their billions, these interest rates were particularly unfavorable. High interest rates make it more challenging to launch a business. Thus, new ventures gradually stopped funding their accounts there. Since they had already withdrawn enough from savings and investments to satisfy their living expenses, they had nothing left to invest. After that, the interest rate soared to 85% over the course of a year, effectively killing the tech sector. And it ended up being quite evident that each of these businesses was significantly overpriced. As I indicated in my first video about the fall of big tech, large-scale layoffs in Silicon Valley followed the industry's recent collapse. Because of this, when the giants stepped in, also, SVB did this. It had already been a terrible year for SVB, and after they revealed they would be selling a huge volume of their securities at a loss, things seemed really awful. Almost instantly afterward, SVB announced that they will liquidate another $2 billion to prevent further damage to their financial sheet. Customers' confidence in the bank did not significantly decline after hearing this news. In one of the worst recommendations ever made by a bank, many of the most important firms working with SVB advise companies to remove their money from the institution. Unfortunately for SVB, ideas like this nearly often result in abrupt bank runs after knowledge of financial decisions and losses becomes public. Now, for those who don't know, bank runs happen when a lot of people think a bank is going to fail, so they all try to withdraw their money at once. Loss and attempts to liquidate firm stock are reflected in SVB's most recent report. It's easy to understand why most people lost faith in the system and started cashing out. Within hours, SVB became bankrupt as customers rushed to withdraw their funds. The bank had to contact the police to prevent people from making withdrawals. There was zero likelihood, however, that SVB would be able to settle its debts in light of its current financial situation and investment choices. This means that roughly $42 billion was taken out of SVB's reserves right before the financial institution failed. So, in a matter of days, SVB's cash reserves went from positive to negative by about $1 billion. Like other financial institutions, SVB invests the vast majority of its depositors' money rather than keeping it in reserve. After investing $91 billion in these subpar securities, however, SVB was left with even less collateral. This leaves them in a precarious position. What makes this tragedy all the more tragic is that it could have been prevented had they diversified their holdings into other stocks. It's puzzling how they could have made such a terrible investment. So that nothing like this occurs, an entire department is usually devoted to risk management. SVB was one such division, although no one seemed to be in charge of it. For 9 months before the collapse, the bank had no leader, and matters were made worse by the revelation that SVB CEO Greg Becker was a member of the board of the committee appointed to oversee his institution. Greg Becker and other officials at SVB sold millions in shares right before the collapse, and this is not surprising given the prevalence of self-policing corruption in the banking industry. SVB's downfall was due, in large part, to the fact that all of their money was placed in apparently risk-free U.S. Treasury bonds. With customers demanding their money back in droves, SVB was facing a mountain of losses during this bank run. And this was beyond SVB's capabilities. As a result, the FDIC was forced to seize control of the bank. The bank was already on its way to failure because of the speed with which the second bank run began and the state of SVB's diminishing investments. It's not like SVB management didn't have any indication that the bank was about to collapse. In fact, before the bank failed, business officials had sold a sizable chunk of their stock. Those at the top who had produced this disruption, and who evidently knew it was due to happen, made sure they would sit comfortably at the top when the classic bank move occurred. Startup founders and SVB's lower-tier customers, however, were caught off guard and given no warning. In fact, the New York office that had customers waiting in line to receive their money back phoned the police. All the data points to this being a major issue for the top 1% of the population. Lindsay, after finding it difficult to provide for her new family, has now started her own business. Her company, the result of many years of labor, is just now beginning to gain attraction. The town's markets, however, collapsed in 2022. Still, investors were drawn to her exciting new venture, but she foolishly banked with SVB. So, when the scandal at SVB became public knowledge, she took the prudent step of transferring her funds elsewhere. Nonetheless, it was too late by now, even though the bank hadn't really failed. Her transfers failed, and now she stands to lose her whole business as a result of SVB's collapse, draining away all of her hard-earned money in an instant and devastating her family and future. People waiting in the pouring rain to get their money back from a bank that has wasted it. The last time something like this happened was in 2008. This quick collapse obviously didn't go well for the folks on Wall Street, as evidenced by the precipitous fall of many of their shares, And this is when people started to comprehend the true severity of this catastrophe. Many members of the liberal elite had invested in Silicon Valley, making their loss all the more personal when SVB went bankrupt. People like the ex-royal couple, Harry and Meghan, reportedly lost millions after investing in the boom of the last few years and then seeing it burst. A loss of $590 million is expected at Winfrey, and the collapse of SVB will be devastating to any awakened investors in that company. However, current government statements assure the public that the global financial system is safe. According to the U.S. Department of the Treasury's Deputy Secretary, the government is paying attention to this particular institution and are confident in the stability of the financial system. Secretary declined to speculate on the larger economic and its sector consequences of SVB's collapse, despite her apparent confidence. When you consider why so many risky investments suddenly became worthless, the pattern becomes all too familiar. SVB may have believed they were being more conservative by purchasing more U.S. government bonds than other banks, but this was ultimately what contributed to their demise, because they were betting on the interest rate remaining low. As a point of comparison, SVB had about $209 billion in assets at the close of the previous fiscal year. U.S. government bonds make up the bulk of those holdings. This means that the last time a financial institution of this size failed was in 2008, with the failure of Washington Mutual Bank. The failure of SVB was the second largest in the United States. In any case, linking this to events in 2008 is completely absurd. I assume this is a separate bank with new management. No, not quite. It's possible that the same people who gambled the economy to ruin did it again with even riskier securities. Yes, you're absolutely right. Former Lehman Brothers CFO and current SVB executive Joseph Gentile is now a member of SVB's executive team. He presided over the worst banking meltdown in history and has just repeated the process. The CEO of SVB declared that the company would be sold to raise $2.25 billion after losing over $1.5 billion on failed bond bets, effectively sealing the company's fate. The stock price dropped by more than 60% once news of the company's financial difficulties became public the day after the announcement. The CEO later revealed on March 10 that not enough money had been raised for a full recovery. They were desperately trying to find a new owner for SVB. By this point, however, it was already too late, and the government had already seized the bank. Almost all of SVB's commercial accounts are not protected by the FDIC's insurance, which is a major setback. Coverage limits for FDIC insurance are capped at $250,000. The combined value of the other 97.3% of SVB accounts dwarfs this sum. Since the bulk of the companies whose funds are being held by SVB are not covered by insurance, they are currently unable to access those funds. Therefore, it is possible that these subordinate businesses would fail since they will be unable to access their own funds. Who, exactly, is to blame now? To be honest, this is entirely SVB's fault. Instead of diversifying their investments like most other banks do, the bank made the extraordinarily unwise decision to bet only on the Federal Reserve's interest rate not being raised. Many healthcare providers have had their clients' financing withheld because their assets could not be liquidated in time. They are in for a long wait before they see any return on their investment. Etsy, Circle, Roblox, and BlockFi, among others, may never see the hundreds of millions of dollars in SVB they once possessed again. Authorities have intervened to close the bank and manage the remaining assets. Although the bank has given its employees 1.5 times their salaries for the next 45 days if they stay on to oversee the funeral proceedings, it is unclear how much, if anything, they will be able to save in light of the current chaotic circumstances. You might be wondering if the SVB failure would lead to another financial crisis, like the one in 2008. Well, we can see that it has far-reaching effects. Thousands of UK startups and enterprises were formed by SVB's British arm. All of them are now in grave danger. As a result, the UK government is holding urgent meetings with tech firms to discuss a possible bailout of the sector. For the low price of £1, HSBC has agreed to acquire all of SVB's UK operations, including all of its debts and liabilities. However, it also provides the possibility of financial gain. It's evident that financial institutions are worried that this collapse might have a domino effect on the economy as a whole. But this isn't just a commercial decision. However, discussions have begun. Some see this as an indication of things to come, while others dismiss it as an isolated incident. However, the most important consideration when thinking about a repeat of 2008 is timing. It's where the money from the other banks is going. And if those banks have been mimicking SVB's lead and putting most of their depositors' money into US Treasuries, then things could take a very serious turn for the worse. Nonetheless, it's possible that this is an outlier and that SVB isn't actually any worse than anyone else when it comes to making bad investments. The signs of a repeat of the 2008 financial crisis are abundantly clear. I mean, if you look at the numbers, SVB might easily be the first of many banks to fail. Other banks with ties to tech and other growth sectors are experiencing cash flow problems and might suffer greatly if SVB were to fail. Many industry experts, including Peter Schiff, argue that this is just the beginning of a domino effect. Others, however, disagree with Peter Schiff and his supporters. This is because hazardous investments in the housing markets contributed significantly to the 2008 financial meltdown. Contrary to the beliefs of SVBs, it encourages heavy spending on US government bonds and other securities. However, comparisons may be drawn with little effort. The steps implemented following the 2008 disaster have been discussed by the Biden administration as a means of preventing a repeat performance. Yeah, the issue is raised by such remarks. Given that subprime mortgages were a major contributor to the 2008 financial crisis, may another incident like that one occur in the near future? Maybe because BlackRock is putting a lot of money into residential real estate. Is this person or case going to be the next one to go? Is it possible that anyone who has invested in US Treasuries will lose everything if they turn out to be worthless? In other words, the entire banking system might be on the verge of a nuclear explosion if other banks have invested in the same securities as SVB, particularly taking into account the fact that it has been confirmed by many sources that the government will not be bailing out SVB at this time. It's not a full bailout, but they did pledge to refund customers' money at no cost to the government. Biden has also stated publicly that bank investors will be at risk. The collapse of SVB will have far-reaching effects, and the disease has already begun to spread. After that, Signature Bank failed. New York's regulatory agencies shut down days following SVB. The specifics are still sketchy, but it appears to be quite similar to the SVB case, and these two are probably not the only ones. Many other financial institutions, like First Republic Bank and Western Alliance Bancorp, halted stock trading in preparation for the disaster. But that hasn't prevented their stock from dropping in value. Over 60% of First Republic, over 40% of Park West, and 68% of Western Alliance were lost. This has caused a great deal of anxiety, and many are rushing to sell their investments in the South at steep discounts in the hopes of recovering part of their money. Given how unstable credit has been recently, it's hardly surprising that default demands for credit series have risen dramatically in value, signaling that many investors are betting that they will soon follow. And if they were to fail, it would signal the start of the banking system's actual collapse. No one wants to see another taxpayer-funded bailout after the misery of 2008 and the subsequent years, but the alternative of economic anarchy isn't any better. Given previous events, it's probably unrealistic to expect that bankers haven't been greedy and inadequate enough to cause another financial disaster. That's all for today. If you enjoyed the video, do subscribe to our channel BizVentures, and don't forget to hit the bell icon.